Welcome to another episode of the Galileo Ventures podcast with myself and
Hugh.
Yay! Slightly more enthusiastic than the first episode, maybe a little bit less than the second episode. This is our third episode we're recording today, and we've just hit over 500 listens. Isn't that amazing? I'm going to add a little noise. Woo!
Incredible.
Our audience is huge. Our reach is massive. Very interestingly, though, Hugh, 50% of our listening activity is over YouTube.
So one of our listeners mentioned to me that the YouTube, obviously you more easily see the video. And because we actually rely for a podcast, we ironically rely quite a lot on the video, particularly for the Roast My Deck, for example, section. As a result, you somewhat need to. Is this really more of a vlogcast?
Oh, no. That is a good question. We better make sure we get the terminology correct here of vlogcast.
Everyone wants to be an influencer, and why not be a vodcasting influencer? Vodcasting? I don't know.
There we go. We have it. The first vlogcasting influencers.
I think it's vlogcast, surely.
Vlogcast.
Like vlogging.
Vlogging. Okay, the first vlogging VC influencers in Australia. There we go.
Yeah.
I'll get that title. Maybe there's some awards we can enter. Today, we're going to cover global and local news, including a first look at the latest startup funding figures, which has just been emailed to me from PitchBook. We'll also be roasting one deck, and we'll be answering a couple of founder questions from the last couple of episodes as well. So it should be quite a fun conversation. But first, before we begin, on June 16th, I flew down to the incredible city of Melbourne, where Hugh lives, for a very intimate conversation with a few of our friends, maybe 2,000 of them, to watch Sam Altman in conversation. Obviously, Sam Altman is the CEO of OpenAI and at the very center of the AI taking over the world revolution. What did we think of that conversation, Hugh?
Look, I think it was a really good get by the Startup Network, previously Startup Victoria, now called the Startup Network. I think it was a really good get for them to put on the event. No one else in Australia put on an event while he was on his global tour. So I think A+ in that sense. I think I was maybe less impressed with the conversation. It was, from my perspective, I think it was a bit like high level, wishy-washy, and maybe not as either direct and cutting or really trying to draw out some of his kind of contrarian opinions. I think it felt a lot like it was the conversation you would observe with a politician. Yes. Admittedly, he's just come off a big global tour of speaking to politicians and all that kind of stuff and dealing with all of the regulatory questions. Yeah. And so it doesn't surprise me that his answers were quite political and measured and PR polished in that sense. Yep. But I think it would have been, I think the conversation could have been a lot more like interesting and cutting in a different kind. Whether or not he would have answered those questions, of course, different piece altogether. But I think it also could have been just a bit more raw and a bit more also reflecting, I think, of the fact that the audience was full of like founders. And I think there could have been an interesting exploration of what it really was like starting an AI company that, yes, now it seems people think that it appeared 2 years ago, was started 2 years ago, but it's actually quite an old company.
Yeah. 7 years, I believe now. Yeah. Nearly seven.
And there was some exploration of the early days, but it's what really does that mean? And what did that mean for what you thought about fundraising, what you thought about team building, how you looked at hiring? Now it'd be really easy to do hiring. That's kind of part of the role of what he's doing now with his global tour is obviously recruitment, because that's going to be the next phase of the business. But I think at the same time, like it's that interesting piece of it's much harder to recruit when you're mostly unknown. Sam Altman was never really unknown, but when the business is mostly unknown as compared to now, ChatGPT.
Correct. Fastest growing 100 million user count product, maybe not usage, but I presume usage is high. I agree on the conversation. I think it was a bit interesting. I found it a bit more interesting than I was expecting. And that's probably because there was a long Q&A. So for those that weren't there was about a 25-minute like on stage Q&A with the moderator, and then about a 30-minute-ish Q&A with the audience, where we got some pretty kooky questions as well as some interesting questions, I think, as you usually do with Q&A. For me, one of the most interesting things he said was around focus. And what I mean by that was one of the questions was around how do we utilize ChatGPT to make products. And I thought Sam made a really interesting point, which is there are a lot of very cool demos out there, but it's very hard to make robust products. And his suggestion was companies should probably be focusing on improving internal processes with LLMs way more before they should start thinking about selling stuff to customers utilizing LLMs. And I thought that was a really interesting point because it's still very hard to make robust products. Having said that, then inspired me to wonder how people are using LLMs inside their companies. If you are listening, I would love to know. So if you're on Spotify, you can actually just chuck it in the Q&A at the bottom of the app somehow. I haven't done it, but apparently you can. If you are not on Spotify and you just want to email us, just email us team@galileo.ventures. I'd love to know how you're using LLMs internally to improve your processes and productivity by like more than 100x, right? Is there anything you're doing? Just let us know and we'll pick out a couple of those. So yeah, that was a cool one.
I think the other piece, perhaps a more esoteric and philosophical question that I thought was lightly explored, particularly towards the end of the piece in those audience Q&As, was around the question of what is OpenAI's sort of moral and ethical responsibility in terms of how it tailors responses to the local environment of the user. Obviously, the answers you might get around various questions would be very different in, say, a perhaps less democratic country or countries with a different approach to sex and gender and sexuality and things like that. The expected or the sort of midline cultural answer is quite different in some of those countries compared to what you would see in a different country. Even, I guess, sometimes you see the difference between just like the sort of American culture coming out of ChatGPT in Australia and the way that sometimes, obviously, Americans have similar culture, but there are obviously some differences that clash can happen. And at what point is it about, I guess, enforcing, for want of a better word, but pushing the American cultural expectation and, I guess, perception onto the world as compared to building something that is taking each of that local culture and then delivering the local culture's ChatGPT back into the local culture itself? And how do you do that while still reflecting also the fact that given ChatGPT is trained on the internet, how do you do that in a context where you're also bringing all of this bias and everything else that's been around on the internet for a long time, cultural and otherwise? How do you build a model that then takes all of that into account in a way that is morally acceptable?
It's a good question. Sounds like there might be a startup in that potentially.
Sam essentially just quasi sidestepped the question, but it is a very good question. There's not really a right answer.
Did he sidestep it? I don't know if he sidestepped it. I think his answer was somewhat illuminating, and some people maybe overlook the answer, which is, I think his view is there, and I think this is quasi quoting from memory here, that there should be locally tuned versions of language models for each, or AI generally, for each country, right? To the values, whatever they are for each country. Now, I find that interesting because obviously who sets those values?
Correct.
And I think the best precedent we have is Facebook right now. And what we deem as free speech on Facebook and what is not free speech on Facebook.
Yeah, okay. I agree in the sense of I think those issues have come up in the Facebook context before, particularly around things like government control of obviously messaging and stuff like that in some particular localities and what that means. Yes, I agree. I think for me, the difference is that unlike Facebook, ChatGPT isn't necessarily like a content publishing system, but it is in a sense of they have more control over the content output in the first place than you do out of Facebook. Obviously, Facebook is about like moderation and stuff from actual user generated content. And that's different when you're taking even just user inputs and then generating content is a little bit like different.
That's right. It is and it isn't. But I think what I understand based on our conversations I've had with a couple of founders on this is the moderation aspect of LLMs is also coming to this point where it is generating thousands of outputs and then they are moderating it with whether it's human reinforcement learning or some other version of semi-automated version of that, which I also find interesting. So in some ways you are moderating the LLM.
There was that really great piece in The Intercept, I think it was, in The Intercept about the mostly low-income country workers who deliver a lot of that. And actually had a really interesting interview with one of the founders of one of the companies that aims to deliver that sort of human-in-the-loop feedback system to train LLMs.
Yeah.
But who does it with like highly educated, blah, 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 everything. So the medical answers are actually looked at by someone with medical training rather than just, oh, yes, this is a... And so I think there's also this interesting piece of where we've moved on from the OG work of that sort of entire segment of society who are doing image tagging for self-driving cars and things like that into the world of going, how do we actually train these things to work and answer things sensibly? And how do we do it in a way that's also going to try and minimize the number of times that it answers in a way that is going to end up in a media article, right? Because I think that's also going to be the concern of everyone launching a ChatGPT equivalent is, of course, everyone's going to immediately jump in and try and break it.
That's right.
And see if they can make it say outrageous things or
that's right.
Whatever.
Yeah.
And so as a result, like, I think it's going to be an interesting period to see how some of those pieces actually then have to be reinforced.
Yeah, I agree. The other thing that came up with him as well is the biological weapons, creating biological weapons, which is always seems to be the AI dimmer's choice of argument, which I'm always like,
I think
if someone wants to create a biological weapon, I'm not too sure LLMs are going to be the instigator of all new biological weapons. But apparently, OpenAI, according to Sam, does actually train a lot against guardrails, against allowing anything like that to happen. I guess the response I would have is LLMs might be the response to solving a lot of these problems as well. But we won't go into that conversation right now. Let's move on. The next bit is our take on the news. We're going to go through 3 news items and go from there. Our first news item is, of course, the big Apple announcement on the Vision Pro, noting that there was no use of the word AR or VR or anything close to that in the announcement. On the 5th of June, at the end of their WWDC keynote, the product will go on sale early in the US. One of our investors in Galileo Fund has already committed to buying one, even though it's a little bit pricey, which will be interesting. So I look forward to having a spin when he gets it.
400 US?
300, 400 US, which is what the exchange rate, the way it is, like 20,000 Australian probably by then. I don't know, who knows. Just for those that have been living under a rock, it's a very interesting headset. It's extremely advanced. You've got 4K micro OLED displays with 23 million pixels combined, which is insane in front of your eyes. You've got obviously eye and gesture tracking. You have 3D photo and video capture, built-in spatial audio, and the most interesting thing is the Vision OS operating system. The bad is there's an external battery with 2-hour battery life, but that's not too surprising because battery has always been a big problem with heavy VR headsets. Oh, sorry, not VR, the Vision Pro. I think my take quickly is I love the see-through aspect.
AR.
Yes, in terms of being able to see around you, but also people can see your massive googly eyes in the headset, which is yet to be worked out whether that's going to be naff or interesting. And the directional speakers is cool, so you're tuned into the environment, right? You don't have big things over your head, eyes, and ears, so you can't hear anything. I thought an interesting quote was from Palmer Luckey. For those of you who don't know, he's the co-founder of Oculus, made a big exit in the heady days of VR to Facebook when he sold it for, I think it was just over $1 billion. They basically, to quote him, they basically did everything right. Before VR can become something that everyone can afford, it must become something that everybody wants, end quote. And I think that's a good point. Hugh, what is your view on the Apple Vision Pro?
Look, I don't know. I've always had the view of almost invariably in any AR or VR, whether it's Google Glass, RIP, or elsewhere, you always look like an idiot wearing and using it. And there was a period, and I think the counter argument to that is like, there was a period where you looked like an idiot having those white Apple earphones in your ears in the early days of the iPod, right?
I'm wearing them right now.
Correct. In the really early days of the iPod, you looked like an idiot wearing those things. And I guess they did successfully make that almost like a fashion item. And you looked at the way that obviously a lot of the marketing campaigns were for the early iPod and all sorts of stuff around how that was like a sort of virtue signal that you would be able to show by having your magical white headphones. That's I think now that has driven a lot of, I guess, cultural change, and even look at the way that people use AirPods now. And I think back maybe 4 or 5 years ago, it would be unheard of to leave your headphones in while you're checking out at the cafe or something, whereas now it's seen to be okay to have your AirPods in for some reason.
Is it okay? I still think people hate it, but people put up with it.
I personally find it rude, but it's much more socially acceptable and happens in a way that 5 years ago it wouldn't have. So I guess I feel like it still is an ugly headset. It still has not really a strong general consumer use case outside. Like, I'm not going to have meetings with you, James, in VR.
Oh, gosh. I was looking forward to our first episode being recorded.
I would rather die than spend my day, spending my day in Zoom calls delivered via AR/VR. That honestly is like my worst nightmare. So, I think I think it's right in saying like there's some interesting places and stuff like that. You know, like will I buy one? Look, I own a Nintendo Switch, and I reckon I've played it, I don't know, 10 times. But I bought one because I was like, oh, everyone's got one of these Nintendo Switch things, and I got to check out what it's like and technology. And Mario Kart was fun for about a day.
Friends are around, it's fun.
And yeah, and so the reality is, yeah, I'll probably buy one just because it's the classic. You got to buy something and see what it's like. But do I really see myself using a lot at the moment? No. And maybe I'll eat my words, and actually I'll be totally wrong, and it'll be a massive thing. But we'll find out.
So I'm just going to share a very quick tweet, which I thought was very apt, talking about the use cases of this, which is a tweet from Alex Cohen. For those of you that are not watching the video, he says, imagine seeing this in VR. And it's obviously that lovely lady with the VR headset in that amazing living room with that insane designer couch, very Apple. And then the All In podcast with the All In podcast host, who I shall not name, in VR around you. It is a joke, obviously, although some people fail to see that. What is your view on the use cases, right? And so my biggest gripe here is there is no strong use case beyond having a floating screen, watching it on TV in front of me, which I get is fun as a single individual use case.
But it feels like you're like getting like you may as well get like a hat that like holds your phone at a distance like this. It's like you're stuck on a continuous FaceTime call that just like lives in the front of your thing, and there's like a little stick coming out of your head that just holds on your phone. Right?
Yeah, because I want you floating around my living room.
Yeah, exactly. I mean, aesthetically, a little bit probably more pleasing than that, but like functionally, like you look at a lot of the ways that they're describing, and they're obviously mocking up a lot of the use cases, and the use cases are pretty much just imagine if you just had a phone that was like stuck there.
Yeah. I did see an interesting article with someone who's been talking to a friend who's an engineer, has been using it for a couple of months internally at Apple, obviously. And that was interesting because the behavior there was suddenly you can't just bring up screens around you automatically, which I think, yeah, that's interesting. But in the end, you still got this huge heavy thing on your face.
Yeah.
And
it's like, in its defense, that was the idea of Google Glass, right? The idea of Google Glass was like you would have like the screen that like sat there, and you'd be able to have stuff pop up like the sort of sci-fi style contact lenses or whatever. Yeah. And let's be honest, that was a huge bloody failure.
It was. Speaking of Google, in related news, Google has stopped working on their project to develop augmented reality glasses, just as Apple is about to launch theirs, so they're missed potentially. They're shifting their focus to software that runs on the devices, which can be made by many other companies, definitely not Apple, obviously. And I would also just like to mention that we are actually investing in what I'll loosely call AR/VR related investment. In a 3D world investment is how we're thinking about it now, because actually we think where it's heading is much less about the headset and much more about the software that enables the 3D worlds and how good and useful that is on any device, which we'll be announcing later. Hugh, what do you think are some use cases founders could focus on if they're thinking that the next billion-dollar company is going to be made off the back of the Vision Pro?
I have no idea.
I thought I'd just put you on the spot.
I think the reality of the coming back to the Google piece, the reality of the Google decision is right, because it feels like Google has demonstrated time and time again they are not a hardware company.
Oh, absolutely.
Right, and so like the idea of them, whereas Apple, on the other hand, realistically pretty crap on a software basis, but on a firmware and a hardware basis, nailed it, right? I'm excluding like Mac, the entire Mac ecosystem. Let's exclude that piece. But I think by comparison, Apple's hardware skills are so much better. And I mean, we've even seen the same story with Google and Android versus things like Samsung and stuff like that in terms of actual hardware manufacturing versus adding the sort of layer of value on top of that. So I think the question really here is what are going to be, I think for founders is, and it's been this way for a long time, right? It's like really like, what are the early use cases? What does it actually look like? What are the places where there's a great degree of pain that somehow gets solved and unlocked with AR and VR that wasn't previously already unlocked, right?
Yeah,
like,
agreed.
It's not new that we can sit on Zoom with each other.
Crazy. Zoom. My favorite thing to do, sit on Zoom with you all day. Moving on, early stage news. For those of you that do not know or are not raising right now, global startup funding is down approximately 40 to 50% across the board. So we are at the end of June, so the very first figures are coming through, but global deal volume across the board is 40 to 50% down across major geographies. Q1 global deal volume reached 76 billion, which is a 53% decline from 162 billion in first Q1 of 2022. No surprises there. But interestingly, from PitchBook, which has just released its stat, although I'm not too sure how much of this is quite yet public broadly, seed stage startup valuations and deal size are rising. And so what that means is the median valuation of a seed stage startup as of June in the US sits at about $11 million USD, and the median deal size sits at about 3 million. So we're obviously seeing a lot bigger checks a lot earlier. If we then look at Australia, based on our first quarter, we had about $661 million invested locally into local startups, which is 50% below 2021 and 20% below 2022. So not quite as bad as some other places, but still on the decline. And then obviously in Europe, it's very similar. It's about 40% decline across the board. Hugh, you go first. What's happening here?
I mean, the reality is the party round growth rounds of days gone by are well and truly over. Everyone's well aware of that now. We're not doing these crazy valuation mega up rounds. Like Zoom is no longer trading for 280 times forward earnings. Like, you know, everyone sort of agrees on that on the tail end, I guess, on the growth end, the late stage investing end. What I think is happening at the seed end is people are realizing that actually the net impact of a lot of that is that you're going to have to generate and show more traction before you can raise the next round. And I think that's why we're seeing seed stage deal sizes increase, is because they're taking the model of, I need to raise more runway and or have more people, more R&D, more cycles, everything else, in order to be able to get the traction that I need to go and raise the next round. That bar is higher. The reality is, like, seed stage valuations, thing that never really shot up the way that obviously later stage valuations shot up in the first place, and have stayed not static, but relatively static over quite some time. And so I think what we are seeing is the net impact of that piece going, oh, actually, assuming I can, which is not always the case with all founders, but assuming I can, adjusting for dilution and things like that, I'm going to try and raise a larger seed round to give us more runway and more of an opportunity to be able to hit the goals that I need to hit in order to go and raise my A or B or whatever it is.
Yeah. I broadly agree. I think the other consideration for founders looking to raise money is that the VCs are sitting on a lot of dry powder. And what that means is they've raised a lot of money over the last 3 years. And right now they need to deploy that money, but there's not a lot of good investments to make. So therefore, what are they going to do? They're going earlier rather than going later. I didn't include the growth stage stats, but it's like carnage, right? There's way less volume at growth stage. The valuations are down. It's about 34% of all growth stage deals in the US are down rounds, which means the valuation is less than what they last raised, which is not that surprising. And what that means is everyone is a lot more cautious, but they've still got to make investments. So in some ways, it's a great time to be pitching a seed stage startup, but in other ways, it's bad because the time to raise is also now longer. And one of the interesting points about the PitchBook report was that from founding to raising a seed round, so there might be a round in between that, which sometimes they call pre-seed, is about 3 years now on average in the US based on PitchBook data, which is obviously a limited selection. But what that means is at seed stage, people and VCs are expecting way more traction, which I think is also very hard as well. And so you've got this weird dichotomy of more money earlier, but also more traction expectation, which is making it very difficult for founders. Moving on, speaking of the heady days of investment, for those of you in Australia, the AFR, which is a newspaper locally, had their Entrepreneurs Summit in Sydney, which I was not invited to. I'd just like to make that clear.
All right. Neither was I, James. So neither was part of the cool kids.
No, I'm not too sure how many CFARs were invited.
I think we were invited insofar as anyone could buy a ticket from AFR.com, sure. But sure. I'm not sure I'm someone who buys tickets to things like that at the corporate event rate. Let's put it that way.
Yeah.
If only I had the budget of an innovation manager at a large telecommunications company.
If only. We'd be in a fancy studio if that was the case. They're not recording.
We'd be flying our private jet and recording on that.
Why not? Next episode. The headline from the article, for those who haven't read it, is VCs told to get real about their role in the tech wreck. Obviously referring to the crazy heady days of 2021 valuations. In particular, this was an interesting article because it was an anonymous critique of what was said on stage. I'm just going to quote a little bit from one of the panelists, which is Nick Crocker, who is a partner at Blackbird. Obviously, they're one of the biggest funds in Australia. And he said, the problem was there was a large number of investors lining up to fund companies that were growing really fast. So the rational thing for a founder was to grow really fast because that's what you got rewarded for. So anyone that says being cautious in 2021 and I had to slow down and be efficient, that was dumb because no one was rewarding efficiency, end quote mark. He then goes on to make some other quotes about being rational or not rational, but the argument he's trying to make is it was very rational to make crazy valuation bets. The critique now, the anonymous critique, guesses on who this is, what Nick fails to take on board is the long-term ramifications of a period of irrational investing. This is not some intellectual discussion. If your fund was heavily invested in 2021 valuations, then it's highly likely this would dramatically be underperforming fund and that your investors are a little bit fucked. He then goes on to make some more things, but the point he's trying to make is, quote, this just stops VCs taking responsibility for stupid decisions. Do you agree with the critique there, or what is your view here?
Look, I think Nick's comment probably fails to some degree to acknowledge the piece that really a lot of it, like what drives up those valuations really is competition, right? So when there's all this money trying to flood into these companies, that's what drives, as we say to founders, the way to get better terms is more competition, right? In which case, where better terms equals more money, higher valuation, whatever that might be. I think, as the critics said, I think the challenge is going to be as we then, I guess, forecast those behaviors into this year and next year and things like that. What does that mean? And how much real downside protection did they end up getting? Because sure, it may still end up being a good investment if they had 2 times liquidation preferences and blah, blah, and everything else, and anti-ratchet, anti-dilution provisions and things like that to be able to actually protect them in the event of a down round. But at the same time, like, you don't either want to end up with VCs having some sort of private equity style 51% ownership of the business, or a VC fund having a 51% ownership of the business, but nor do you necessarily want for the broader team and things. Like, it's quite demotivational for the founding team and also the employees, because usually they're obviously pretty much the people that get totally stuffed over. VCs at least have a portfolio approach, but as an employee with options and things like that, like, you don't have a portfolio approach. Suddenly, we've seen this even in the publicly listed companies in the way in which employees suddenly have had all of their options underwater, and it's been a bit of a drama because suddenly those things are worth nothing.
Yeah.
And so I think there's a piece here of where I agree in that I think if you picked any fund that was a closed, the reality is obviously in VC funds, you invest for 3 years and then you have 7 to 9 years to be able to realize the value of those investments. If you spent 2 of those years investing in what is very overinflated, so you spent 2/3 of the available time investing in things that we're acknowledging now are overinflated compared to what the market is now, you'd better hope in the next 9 years that the market's going to go back into hyperinflation and go up to above where it was in the past, or the math just doesn't work out. It's not like they have another 9 years of investing to be able to then average out the expected returns. You only have 3 years.
And I don't think it's going to happen. Like, I think the tech bull run we've had is not going to repeat itself within the next decade. I think it's going to be...
Certainly not to the same degree.
No, definitely not. Fun insider story. I talked to an investor who's invested in one of the top US funds, literally one of the top what we'd regard as tier 1 brand name fund. And most interestingly, they have written off their 2021 fund. They've basically written off all the investments they've made, and they're starting from scratch with the money they have left, which is pretty extreme. But what will happen? And I think the point that, again, just to maybe change the perspective here, because it's not so much about the competition, which, yes, if it's highly competitive, the valuations can go up because there's more money. I think the point here that's interesting is, how do you explain this as an investor that's been paid to make rational decisions with other people's money? And I think if you buy into FOMO, I think you just need to admit you buy into FOMO. Like, you don't think you should intellectualize it, in my view. It's just like, no, we bought into FOMO and we wanted to be on this round and we paid an exorbitant price. I don't think there's anything necessarily, I think it's bad, but I think if that's what happened, you should just own up to it, in my view.
It's, I guess, you're right in the sense of saying that there was obviously that period of cryptocurrency funds where everyone was going, oh my God, if you're not in cryptocurrency, how are you missing out on this 3x up everything else performance? And some people and some investment managers did fantastically out of that. Like, actually in terms of dollars generated and money returned and everything else, they did amazingly. And that was like, if you called it at the right time, you got your money out at the right time, you invested in the right bits during that period, you're a great investment manager. I think the challenge in VC is that you are generally investing in much more illiquid assets. And so your time horizon of realization has to be a much longer time horizon. Yeah. And so you have less of the ability to be able to like cash out as the thing falls apart in a way that you would in the cryptocurrency market. But there was a period there where it was like, it felt like you're an idiot not investing in crypto deals.
Yeah, but I don't know if I call cryptocurrency investing or speculation sometimes. So.
Yeah, but I think that like the principle still holds though. There was a period where it was like, you look like an idiot. And then afterwards, everyone can turn around and go, oh, thank God, I'm so smart that I didn't like. But I think if we'd had another 5 or 6 years, 3 or 4 years of the same tech bull run, those people would have seemed like absolute godlike geniuses.
Yep, that's true.
And all the people that sat on the sidelines saying, oh no, the deals are too expensive, we're not doing any deals at this point in time, seem like idiots.
Yep, that's true. That's right. The bear doesn't get rewarded if you're in a hype cycle.
Yeah. And sometimes we certainly think about that. And one of the challenges, I think, as an investment manager, right? It's different if you're an angel or family office or things like that. You're operating on a different time horizon. But as an investment manager, our investors have given us the money expecting us to invest it over 3 years. The expectation,
which is a very short timeline, just
is that
usually it's 6-year investment horizon for
the money's got to move. The money, it's like they haven't paid us to just have it sitting there in a term deposit. They're having it sitting there to put it into high risk assets.
That's right. That is true. But in the end, the results will speak for themselves, and we will see who the high performers are and who are the low performers in about 7 years' time, which is fun. the long horizons of venture. Okay. Thank you for that, Hugh. We are now moving on from news. We are going into our next section, which is Roast My Deck.
I'm waiting for the like, where's the little sound effects?
It's coming. I'm going to insert them. I almost need to play them so we can hear it.
Yeah, we need a soundboard.
We're going to go through one deck for this podcast episode. I wanted to show one deck which I thought was a little higher quality than the last time we ran through them. But obviously, you've barely seen this one.
I don't think I've seen it at all.
Yeah, so we're going to go through and do a live react, and I'll give my thoughts, but we'll go through with Hugh. We'll skip the title slide and jump straight into slide 2.
So I want to go back to the title slide briefly because
okay, we can go back to the title slide. We'll go back to the title slide. And sorry, just so everyone who is listening, this is a company called Carbon HQ, and the tagline is Digital Infrastructure for the Global Carbon Credit Industry.
The principle here is that we are sharing kind of the raw thoughts and feedback as we roll through. And obviously the founding team has opted into us doing that in public, but the intent here is to see what and understand what VCs think about as they roll through these decks.
Correct. That's right. Thank you.
So I think you give it, again, nice first slide. I like the design aspect of this. You're like, oh, someone's put effort into design. My first piece here, though, is to say digital infrastructure of the global carbon credit industry. And I go, I've seen 50 of these. I've seen 50 of these and doesn't yet tell me what this team is going to do different. I get that it says what they're aiming to do, or at least to some degree what they're aiming to do. But on the VC side, you've seen tons and tons of these like carbon credit, carbon accounting, everything else pitches recently. And so I think if I was pitching this, I would want to make it clear from this very first point what it was that I was doing different to literally every other one that the VC has read.
Okay, cool.
I'm
going to move on to slide 2.
I like it.
There. It's a team slide. You got the 2 co-founders. It's actually very well designed. I've got to say, kudos to the design. I quite like it.
I'm not sure I like the hi there style, but again, that's a bit of a religion point. You could just call it team. I like the piece. I like the piece of the way that it very clearly and quickly communicates that this is a team where one person has the industry-specific knowledge, the other has built software.
Yeah.
And I like that. Nice, clean, simple, cool. We've got a standard co-founding team of someone who has deep industry experience or industry perspective, whatever, the business person, quote unquote, and the tech person. I like that. Nice, simple.
Yeah, I agree. All I would make highlight here is for a lot of the pre-seed founders we get, it's very hard sometimes to work out who is on your engineering team. They hide it, or sometimes they don't talk about it, or sometimes just talk about one of the co-founders. Make sure to talk about who leads up your engineering. And the other aspect is if you don't have anyone that are doing some of the functions, but you have someone ready to go, it is fine to put them on the deck and be like, this is the person that's joining us after.
To hire, or joining post round, or whatever it is you want to do.
Right. Much better to do that than just to leave them off completely and look like there's no one on the team. Okay, next slide 3. It says, we are losing the fight against climate change. It's crucial that we decarbonize what we can use and use carbon projects to offset what we can't.
Yeah, look, any company in this space can put this on their deck. And if the VC reading your deck doesn't believe in climate change, they won't invest in your company. So it's like, don't just put these, from my view, don't just put these sort of like hand waving, oh yes, we all agree with this in principle, because it's like, yeah, we all agree with this in principle. If I believed that climate change didn't exist, I wouldn't be investing in climate companies.
Yeah,
and you wouldn't want me as an investor either. But you don't then need to say, oh yes, climate change, important. I'm like, yeah, no shit, of course it's important.
All right, I'm going to skip this one and go to slide 4 then. Slide 4.
Sure. I think this has too much complexity already.
I think that what I'd love is slide 3 to actually be more of an introduction to his problem and less of a climate change is important slide. And this one kind of just dives into the detail without really saying much.
Yeah. You look at the slide and you go, yeah, cool. Voluntary carbon market, it's gone 4x and then it's going to go 5x in 8 years. And I go, it's not necessarily like J-curve, but whatever. Sure.
Yeah. A good trick that we've been using with our founders is if you have a slide that is very complicated, ask yourself, what is the one key message you want someone to take away? And if it is not entirely obvious within a glance of a slide, then it is too complicated and you need to reword or re-emphasize something.
I think you could take any one of these 3 metrics and put it on a graph and call it done.
Yeah, I agree.
And if people wanted to get more detail, then they can get more detail.
Yeah. Okay, next slide, 5. But carbon projects are currently buried in Excel, email, and PDFs. Okay, now we're getting into the problem that he is addressing as opposed to setting up the problem, the market.
Yeah, I don't like this one.
How come?
It makes it feel a little bit too much like you're building a productivity suite. I think, again, it's a bit wishy-washy, and I think there are better ways of saying, because I go, is this trying to say the problem is these people in all these different roles find it hard to collaborate? Is it the problem that these people in these different roles don't know the data that the other people have? Is it the problem that everyone knows all of the data and everything else, but it's just not nicely collated and displayed? And all of those things are different sets of problems. And so I'm like, okay, carbon projects, of course, carbon projects are in email.
What isn't in email?
Yeah.
Like, is the problem I have with these types of statements is the solution then we never use email again? Well, and obviously that's not right.
Again, like the big piece here is like, sure, carbon accounting, big space or emerging space, and currently it's all in Excel. But that doesn't necessarily say why it needs to not be in Excel. There are lots of things in very late stage in finance that are still in Excel. You do a bond offering, Excel is going to be in there.
If you run a bank, it's an Excel spreadsheet that you have to submit, right?
Well, yes, but I think it's not every time we swipe our MasterCard, it's going back into some giant Excel document doing double entry accounting, James.
You never know. Somewhere, someone's checking it.
That's what mainframes are for. It's actually just really big Microsoft Excel documents.
That's right, yeah, that's right. Slide 6. And this is holding back the carbon industry. Is Excel holding back the carbon industry?
Yeah, I'm not trying. I agree in the sense of I'm like, okay, like but part of me is look like this is the story of every nascent industry, right? It's not very efficient. It's consultants eating a thing of chips outside a fish and chip shop. Like there's seagulls, and there's varying degrees of quality. Like you could say exactly the same thing about Bitcoin. Say the same about cryptocurrency. Like every emerging segment has this period where it's not clear who's good and who's bad. It's not very efficient. There are consultants and scam artists all through this place. And I'm like, yeah, sure. Yeah, I don't know if it's software that's keeping that back or the fact that it's stuck in email and Excel. I'm like, not sure about that.
I would say for this founder, I think the problem here is not Excel. The problem here is what you're trying to get to, I think, is integrity of carbon
it's
project.
I would say professionalization.
I think that's a different problem than just simply going, oh, I've got a lot of emails.
Yeah.
Meet Carbon HQ, the simplified way. So we are at the solution slide. An integrated platform for carbon projects. I don't know what that means.
It may as well have been the first slide, if you ask me.
Yeah, that's right. Also, I have an aversion to anyone that says an integrated platform because it says to me that you have no idea what it should be.
Yeah, I don't know. Whatever. Integrated platform. Who has disparate platforms?
Slide 8. Developers get unparalleled developers in the carbon project sense. Not
Carbon
in
project
the
developers, not
yeah.
software developers. Yeah.
Yeah. Unparalleled clarity across project lifestyle.
So at this point, I'm saying to myself, oh, so are they building like a project management marketplace? Is that what they're building? Is this like a project management thing? Is how they're going to acquire the developers on one side and then have the sort of carbon accounting on the other? I'm not sure. It's not really clear to me if it's is this maybe I'll find out in the next slide perhaps. But like at this point, I'm going, okay, cool. So they've built like project management-y stuff for carbon credit developers. But like we've also just been talking about the organizations that have too many emails.
Yes, correct. Slide 9. Which spreads their organizations they work with. Okay, I think we're getting into the meat of the solution here.
This now just says to me, okay, so what the problem is here is that we just need a better way to be able to do standardized data reporting into standards bodies, regulators, buyers, investors.
I think so.
Cool.
That's my interpretation. Which again comes back to my whole integrity problem, which is different to an integrated platform problem.
Yeah, and this is also where I'm like, so who is like the buyer and the end user here, right? Is the buyer and the end user the developer who is like doing this in order to improve the integrity of the results and acquire a better buyer or a better value for the investment or whatever that they're selling? Is the user here actually the like buyer or investor? And then we're like working our way back, and the developer is in that sort of supply chain as a way to be able to improve that buying experience. I don't know. It doesn't really say much of that.
Potentially. Slide 10. And taking the carbon industry into the future.
Again, I'm like, great. Nascent industry is going to become more professional.
Yeah. This is the same slide as I think a few slides ago anyway, with just a different heading title. So I'm not too sure.
I get that they're trying to do the opposite and go, oh, look, it's a before and after, but I don't know. I think
it's a week
same
before and after.
Same comments of the previous slide apply to this slide.
Yeah. Okay, journey slide 11.
Met, born, prototype, project. Okay, so you've said interviewed 40 project developers. So this is for a project developer. Okay. I assume.
Yeah, I think the biggest criticism here is I still don't know who the buyer is. And I should know by slide 11.
Yeah. But I guess the buyer are the people who are presumably carbon developers.
I presume there. I don't really know what carbon developers look like, all their names.
I think the second part for me is also help me understand the size of these things. Like I think in a nascent and emerging market like this, give me a bit of intel. It could be in an appendix if you want to have it in an appendix and put a footnote saying more information on the market in the appendix. That's fine. Yeah. But give me some more intel about, okay, so if the market is project developers of carbon projects, help me understand about how that market stacks out. Like what is big in that market? What is middle? What is little? Where are they globally? How much of it is like a winner-take-all piece? How much of it is like a mum and dad job? Help me understand a little bit of that, 1 or 2 slides, before you then say, okay, so here's who we're we're going into this market, mid-market. We're going into this market, enterprise end. We're going into this market, SME end. I don't know the answer to that because I don't.
Yeah, I agree. I think founders often have a struggle to tell us how they segment the market and what's a big and small company and what the definitions are. A really quick way to do it if you don't know how to do it is just to put employee size.
Yeah.
That's a really easy way to do it if there's no segments that exist yet, if it's a new market. But that's one way. Okay, slide 12. You were going to say something?
I was going to say, now look, some people will obviously know, in which case, great, they can flick over those slides. Like I think that's where either put in an appendix, and if I was pitching this to a specialist carbon environmental impact type fund, I might consider putting that in an appendix. And for a more general fund, I might put that in the deck. Right, so you can actually tailor that a little bit insofar as you don't necessarily want to go to an investor who's invested in 10 carbon capture project management tools and say, let me tell you about the market, because they're going to go, oh, yeah, I know about the market, I'm not stupid. But for those of us that don't know about the market, we're not specialists in it, give us a bit of that color and flavor so that we can understand what you're doing as a result, and you can obviously adjust the deck.
Okay, I'll move on to the next slide. Slide 12.
Sure. This helps in that it tells me it is indeed the developers that are the people who are buying, right? At least today.
Yeah.
And the idea is, and like, of course, in the future, you're going to think about doing this as a marketplace.
Is this a business model? I'd say this is a really weak business model. Pro tip, if you're going to do a business model, make it super clear how much you're charging to who.
On the left here, Jack.
I know, but it's not. I wouldn't call this particularly clear. I'd call this like we're thinking about business models, or we're ideating about multiple different types of business models. Whereas I don't think you should be presenting the full range of all business models. I think for business model slides, keep it really simple. This is what we'll charge right now today. And I think just make it simple. And then if the investors engage, you can talk about, yes, in the future, we'll generate revenue in all these other ways.
Yeah, sure. Or at least have put 60% of the slide by area is on current business model and 40% is on potential future areas of expansion. Maybe think about it that way, or 80-20.
Yeah, but I think some founders get really caught up in this whole thing of, we'll make money when in 10 years' time when we can do all these things. And that's a weak business model.
Yeah. For all we know, in five years' time, half the countries around the world will run their own local marketplaces.
Potentially.
And there's not a SaaS intermediary. It's just literally... Okay, competitor slide.
2x2.
I don't mind this. I think this is a good way of showing this information, better than the ticks and crosses. I like this actually in that sense. I think I'm not sure I agree with the positioning here. I feel like the positioning is like, what you're doing here is you're saying we are entering right at the start.
Yeah.
And we're going to own the developers. And by owning the developers, we'll be able to have the power to control all the people downstream. And whether or not that's going to be right, we'll find out. But I think saying that, because what the carbon accounting firms are saying is we're going to own all the buyers. And as a result of owning all the buyers, we'll be able to demand what all of the developers and everyone else ends up generating in order to put into my box that I need to do my reporting on. And we don't know the answer as to which one is correct, but I think you can argue in either direction.
Yeah, I agree. I don't have so much to add to this one. I'd prefer this one to be higher up in the deck in some ways. Yeah,
probably.
Because rather than trying to explain it through an abstract way with 4 slides, I just put this on here, and that helps me get up to speed pretty quickly with the market landscape.
Yeah, and it helps understand where you're fitting in the sort of supply chain of the market.
Okay, slide 14. We've got 2 more slides left.
So this is again where I come back to, okay, so cool, you're saying that there's $1 billion worth of potential market in SaaS purely. But I go, okay, but how much of these 10,000 organizations are we assuming are developers versus investors versus buyers? It doesn't really, I get that there's probably 10,000 of the 3 of them, but what we're saying is the greatest value we're driving is to developers, in which case, how many developers are there and how many do you reasonably expect would be happy to spend 10 grand a month? Because big ones, yeah, sure, absolutely would. But if it's a 4-person operation...
No way they're spending 120K on you.
Yeah.
No way. And I think that goes to the question of whether this is 10,000 is the sum, TAM, SAM aspect. And that's a bit unclear. I usually just discount whatever they say in terms of the numbers and cut it in half and see if it's still interesting. So this suggests to me that the market is very nascent, very small, still developing. Slide 15, last slide. So I'm going to go first here.
Clear ask.
Yeah, I'm going to say I like this. So this is an ask that's very clear. So I know how much you're raising. I know what you're spending it on. And I know how long you're going to be using it over. The thing that I would only say could be a little bit clearer would be like, what will you achieve? And so right now, the way it's worded is it looks like you're achieving 18 months of runway, but then you're dead. I'm not investing you so you can work for 18 months. I'm investing you so you can create some value. So what I'd love to see is rather than just runways, like to achieve 1,000 customers or something, some number here so I have a sense of the goal.
You want to see the output piece.
Yeah. Because that suggests to me, because I sit there and go, as a pre-seed investor, if I invest, will someone else come in and invest later on, reasonably speaking, if you achieve these goals? which is always a big question mark for someone like us.
Yeah. No, I agree. I agree though in that I like the structure of the quarter by quarter. I like the 3 rows. I really like the presentation of this slide.
Yeah. Okay, great. That is it for Carbon HQ. Hugh, what was your view on that deck?
So I still don't really feel like it really gripped me and told me about what it is that made this team's perspective unique and different. It wasn't like I filled in a lot of those gaps myself in my assumptions of, hey, we're doing this early part of the supply chain and things like I've made a lot of those assumptions, which I think is something you'd probably want to avoid if you can. So I think in terms of that, could probably be some area for improvement. I really like the design. Design was really good. I agree the fundraising ask was really good in terms of what they expected their sort of goals and things like that would look like over that and how they would spend the money. Didn't give me the pie chart piece, but like the pie chart's usually roughly the same. It gave me a clear idea of, okay, this team has thought about how the business is going to progress over the period that they're asking for the funding. And I think that was really great. But yeah, like I think the challenging part here is it maybe doesn't adequately realize and really properly attack the piece of, I've seen a heap of these recently, and so why is it that this one is different and special, and what are you bringing to the business that is different to all the other people bringing the same thing to the business?
Yeah. So my feedback would be, I think I rate this a 7 out of 10. I know you don't like to give ratings. And for those listening, we did have actually now engaged with this company, so we're chatting with them now as a result of this pitch deck and application they sent through to us. Where I would say was really good was a clear ask, and the team seems strong, and you're in a segment that is obviously new and growing. So I love stuff that's in new product categories. I love that. Where I think it was weak was, again, similar to you, not sure what your unique value proposition is, and not sure what you're providing your customers is something super compelling, because selling productivity tools to project developers, I'm going to have a guess, is probably a hard sell. But interested. And so would engage. So on that point, I think it's a good outcome. Moving on. So our last section of the podcast, we are coming to an end, unfortunately, which is very sad for our listeners, I'm sure. We have 2 questions from founders. The first question is, I'm going to ask these to you, Hugh, and then we can go through and get your view. How does the VC mindset change in a recession?
Look, I think it's going to push people towards thinking more about, can this company operate in a capital efficient manner? And what does capital efficiency look like? Is this company is this a luxury buy? Is this a vitamin or a drug? All those kinds of questions I think are going to be like very important for people. They're going to be thinking about, okay, great, is a recession potentially a tailwind for this type of business? Or is it going to be a headwind? So I think that part changes. There are potentially some changes that I guess are a little bit more internally facing, in that recessions are going to make it likely, and even higher interest rates are likely to make it harder to raise VC funds. And that may adjust the way that over a midterm horizon and a long-term horizon, we see venture capital being deployed. As you said, I think that today's fund vintages have ample dry powder, but that's a bit harder to say in 3 or 4 years. And how people might be thinking about going, will I be able to raise the next fund, or will I be able to raise the next fund at a certain size that I would have been able to 2 years ago? Will I be able to do that in an environment or an ecosystem where there is more of a recession or higher inflation, higher interest rate type environment that often pushes money away from VC or increases the expectations of return? And so I think there are those factors that are also going to come to play in terms of some of the psychology of how you think about and how you write checks and how you think about how the market's going to play.
Yeah, that's a pretty good answer. You really covered all the points. I've got nothing to add. I probably would only add, this is a bit more internal facing, so caveat on that. I think there is a change in what is an interesting business for VCs going forward, given that public markets are down and potentially. So I guess my thesis here is, just to explain this a bit more, is that software is losing the multiples in public markets because it's no longer a weird new technology where you have people reward you for the scale and the margin. And I think if that's a permanent thing, then software companies will have to have very different or very extreme characteristics, more extreme than simply just being a software company that has a better margin than a comparable that's not a technology company, is my very quick take on that. But how that affects us is still playing out, and I think deep tech is definitely getting a bit more interesting. Stuff with good moats and competitive advantage is going to be a very big thing. So know how to answer those questions. Okay, second question. How much weight do VCs give to the quality of a board of directors and board of advisors when assessing a company for investment?
I mean, us, if
Yeah.
anything, a big board of directors or a big board of advisors is a negative signal
Huge negative, just to be really clear.
for an early stage investor. Look, I think this is really a question of religion. Some VCs really like having non-executive, strategic, independent board directors or boards of advisors, which are, I guess, just friends. Other VCs go, nah, the industry strategic people don't understand what it is to run a software business or whatever. Like, they don't understand this business and the way to build it for us as a thingy, and they're going to get in the way of my views if I'm going to be a Series A or a Series B investor on the board. And so I think it is a bit of a double-edged sword. The best board of directors, I think, is usually best built with your investors alongside of working out what is the right composition. Is it time that we start introducing non-executive directors? Or is it time that we start introducing non-investor or non-founder directors? Is now the right time for that? As for board of advisors, I don't know. There's board of advisors that are just like heads on a website, and otherwise they get an email once a quarter, and there's board of advisors like you see them in the office one day a week. And I think the two are quite different. And I don't really care, because I think for a lot of our early stage founders, what they will call a board of advisors, I would just say, is people they've networked to.
Sure.
And it's great that you can draw on their knowledge and expertise and things like that. It's not really like a board of advisors. It's more just, it's people that you've networked to who are senior people who you can ask for advice, which is great. And that's very useful to have, but it's not really a board of advisors.
Yeah. I apply the 80-20 rule to these types of situations. 80% is the team, 20% is your advisors, and in some ways, the quality of those advisors. In terms of board directors, I'm going to go a bit stronger, which is below a Series A. If you have a very big board of directors, I go weird.
It's pretty rare to have any board of directors really before a Series A. Beyond just like the founders ticking and flicking in terms of the actual corporate actions. It's pretty rare.
I've seen it with startup spin-outs out of like universities and companies where they think a very professional governance board structure is crucial in the early stages. But honestly, I think if anything, I haven't yet to see any of them provide value other than people that can just jump on a call and talk to them and help them with the strategy, because it changes so much, and meeting every quarter doesn't really help a startup, to be honest. At this stage, you got to be meeting with them a lot longer, just like we do. We meet with them every fortnight sometimes, or even weekly, depending what's happening. So I think board of directors, really, I agree, should be built with your investors and shouldn't be big and onerous too early until at such time you're generating revenue and growing. That would probably be my view. So if you're not generating revenue and growing, I'm not sure a board of directors is going to really help you at this stage, other than getting good investors on board who can help you. That's really it for us. So thanks everyone for listening for our episode 3. We will be back next month with episode 4. If you have not listened to us before, please do subscribe. Galileo.ventures/podcast is where you can get all the details. We are on the major podcast applications. On Spotify, you can absolutely write a comment or email one through at team@galileo.ventures. Thanks very much for listening. We'll see you next time. Bye, everyone.